Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Technical Analyst with Sticky Trades, and we are in the final moments here of the trading day here on March 15th. And as you can see from this daily candle chart, we do have a red candle on the diamonds, and that candle is closing below the 20-period moving average right there. And so when you look straight down from the price action, you could also see we have a cross sell signal on the stochastic. And yesterday we had a cross of the momentum line down there on the CCI. Now looking at the intraday activity, this is going to the minute by minute interval. You can see that over the last 2 days here, we've had a downward move. No doubt that's a downward trend over the last couple of days. And again, right up into the close, you could see we see selling pressure here. We only have about 4.5 minutes before the close. And so I don't see any short covering, which is very interesting because yesterday we saw some of the shorts covering their trades for profit in the final minutes. And we're not really seeing that right now. Backing out, I just want to show you something on the monthly chart. Here we are halfway through the month of March, and you have a bearish harami right there after a long stretch of green candles with the oscillators going down. So the monthly charts carry a lot of weight. And when you look at IWM on the monthly chart, you're going to see that we still have lower highs here. You know, everyone's saying, oh, bull market, bull market. Well, in order to have a bull market, you need higher lows, higher highs. We have lower highs on IWM. We have lower highs in the Dow Jones transports, which if you're following Dow theory, the 6 tenets of Dow theory state that you need the transports to confirm the industrials, and we're not seeing that. But on the monthly chart here on IWM, not only do we have this small little candle, but we have this long shadow above that candle. It's a shooting star. And notice what happens when we get these long shadows, like you see here, here, here. We generally get selling pressure coming into the market after those long shadows show up. And there's good reason for that, because that means that the buyers tried hard to push it up into new high territory, but the sellers said, nah, you're not going there. And they fought back and pushed those buyers right back down. That's what causes these long shadows to form. If you're brand new to candle charts, study my 4 most favorite candle patterns, and you'll see the high probability trades. And I'll talk about that in future videos as we go through. So if you subscribe, make sure you hit the notification bell, and you'll get a really good education on what's going on here with these candle charts. Now, going back to the daily candle, you can see that we are going to close below that 20-period moving average. Momentum is going down, so the pressure is on. So let me go back and start putting some price targets in. I do believe next week the diamonds are going to continue lower. I think we're going to take out these lows. I'm going little bits at a time here. I think the Dow is going to drop and the diamonds will go to 384.72. So that's my target. You could take that to the bank. You could see that all of these other lines, these diagonal lines, are former price targets. You see that? And we're back on a winning streak where you could see here that price target was hit, that target was hit, hit up here, downside hit. This downside I think will hit. Again, not a guarantee, but high probability that we will go lower. Now for the target on IWM, as we come into the last 2 minutes of trading here, I'm going to go a two-parter. I think because of that green candle, we might see a little bit of an attempt to get back up over that moving average. And I think we're going to fail towards the end of the week as the small caps continue to see the pressure of the markets more or less in like a domino effect. I have the short-term target in for next week. Here's my longer-term target that is not yet hit. It's 197.41. So again, for next week, downside target, $200.45. Then from there, 197.41. Moving on to the Qs, ticker symbol QQQ. And what do we have? We have a close below the moving average. Right there, we hit my downside target from last week. But look at the volume increasing on the way down. If you take out my trading checklist, hopefully you have a copy of that, you'll know that increasing volume on the way down is bearish. So I think we're going to go a little bit lower next week on the Qs, maybe even lower than that, but I'm being conservative there at 429.91, 429.91 on the Qs. Looking at SPY, this is the S&P 500 ETF. We have not a close below the moving average, but a test of that moving average. I think we're going to close below that moving average. I'm keeping that downside target right there at 498.67. That is a gap fill level that I believe will fill. So keep an eye on that. Markets are getting weaker. This is a full-fledged pivot point here, and we're about to close. There it is. The market is officially closed. So that downside target again in place at 498.67. And that brings me to the VIX. Notice how we are showing a very tight trading channel here on the VIX. See, I'm going to draw this line, but I'm going to erase it because I don't want to have too many lines on here. See how we have higher lows on the VIX? Now we also have a long shadow on top of the VIX candle right there. Now we already hit my upside target at 1581. So that target's hit. I'm going to draw some new target lines. You see these little pivots that I'm drawing here? That's what we're seeing as more or less a regular pattern. So I think we're going to see the VIX drop just a little bit. I don't even know if we're going to go all the way to that trend line. And then guess what? I'm going even higher on that target. So I'm going to do a two-part forecast on the VIX. Downside target 1371, a bounce, and then right up to 1588. So for those of you that trade the VIX through VXX, or maybe you're trading the Russell RWM, that'll give you some insight as to what the technicals look like so you could manage risk. So that is very interesting. Now, I'm going to show you what's happening here in silver. If you follow me on X, you will have already seen this chart, because what I do on X, formerly known as Twitter, is I make my trades very public, and I tell people when I'm trading, and I give them that information 5 minutes before I actually put out the trade. So today I sold out of 5% more of my silver position. I sold some silver right here. I sold a little bit more, a little bit higher, and then I'm selling the last 5% at this gap fill point. Now, when silver drops, and I feel comfortable saying that it will drop, I will be a buyer right back in this area right here, and I will buy back all of my shares and more. That's called parlaying the position. If you want to follow my silver trades, just go to X and use hashtag AJSLV trades, and you'll see all of the charts that come up. Remember, I give the audience a chance to trade ahead of me, and I feel very comfortable with that because I don't want to trade ahead of the audience. That's what everyone on the financial channels do, and they move the markets in their favor. I'd rather not do that. It's pretty simple. I want to give the audience the leg up advantage ahead of me. And so that is what I put out, and I think silver can absolutely drop. Now, one of the other things I want to talk about before we get into the economic data here, this is the trading checklist that I put out. If you don't have a copy of this, email me at ajmembers@stickytrades.com, ajmembers@stickytrades.com, and we will send you a PDF copy of this. It's a great little tool that you can use. It came up in one of the events that we did in Miami. One of our attendees, Laura, asked me, what do I look at when I'm making decisions about a trade? And I put it down on paper, and I thought, well, this is great because for any of you pilots out there, you know that before we take off the ground, we have to go through our checklist, make sure the engine is running properly, that all cylinders are firing like they should, that we got enough fuel, that we got our flaps set on takeoff, and all that good stuff. Well, we do the same thing when trading. Before you make a trade, you should check the condition of the market. See what type of candle is showing. What is the volume doing? Like I talked about earlier, when the volume is going up, the price is going down, that's bearish. Look at the price relative to the moving average. Look at gaps. Look at the oscillators, the stochastic and the CCI. And then make the trade when all of the conditions are bullish or bearish if you're going to go short. You don't have to force a trade. That's the worst thing you could do. Just because you love Apple or you love UPS or whatever the stock might be, just because you love that stock doesn't mean you have to trade it on that emotion. Make sure the conditions are favorable and then put the odds in your favor. Right now, look what happened here this week. This chart came out through Goldman Sachs. And what I'm doing here is, I don't want to rain on anyone's parade, but I'm just basically dropping truth bombs so investors know what's really happening out there. This has never happened before in stock market history, where the market has been driven so high, so fast on such a small number of stocks. This has never happened before. And here we are at an extreme high after a vertical move. Does that look familiar? From 1925, 1932, right here, and then the crash of 29 and the second crash in 31, which you can't see in this chart, but the bigger crash came in 1931, not 1929. That's when we came from these highs here all the way down to the lows, and the market's lost almost 100% of the value at that point. So can history repeat itself? Sure it can. So what does that mean? Does it mean you should stay out of the market? No, of course not. You just need to understand how price action works so that you're not caught off guard holding a long position in a falling market. You see, so just use common sense, use the charts, use good risk management technique, and then you'll be able to sleep at night as well. So this is something that I've been talking about. I've been talking about credit card debt quite often, actually, and how it's at record highs, but I have not really been focusing on the delinquency rate at all. I picked this one up from Game of Trades on X. I suggest you follow them. They put out really good data. It's just Game of Trades on X, and you can follow along with them. And you can see that credit card delinquency rates are at the highest level since 1991. Pretty incredible, isn't it? Seems that the market is just shrugging all this data off. Well, eventually it'll catch up and reality will set in. Here's another one that I've been talking about, but this is an eye-opener right here. U.S. office vacancy rate is nearing 20%. Now, for those of you who follow charts, you could see that right at this point, we are at the highest level since 2006. There is no pivot point lower. That line is still going higher. And so what that means when you put this all together, if commercial real estate investors are now suffering vacancy risk and vacancy loss, then they're upside down on a lot of these properties because property values are going down. That's going to put pressure on the banks that are holding these mortgages. Please understand that, again, they're keeping that bank story out of the limelight, but I believe that we're going to see another banking crisis starting at the smaller regional banks. And here's what I think the plan is by the banks that are considered to be too big to fail banks. I think they're going to go in and scoop up all these regional banks at an extreme discount, and it's a way for them to accumulate new assets without having to spend top dollar to acquire these banks. So I think the smaller banks are going to take a hit. It'll bring the banking sector down quite rapidly, and then you'll see the acquisitions and the buyouts take place, and then you might see a bounce in the banking sector, but that's going to send ripples right across the entire market. So be very careful about that. Before we leave, I want to thank all of you so much for your likes, your comments, and you're hitting the notification bell and doing all that good stuff that gets the algorithms going. We are approaching 10,000 new members. This is a brand new channel, so to hit 10,000 in such a short period of time is quite the milestone, and we have you to thank. Stick with us. I guarantee you're going to learn a lot. We put everything that we have into these videos and these trade publications, and again, if you're interested in sticking with us at Sticky Trades, then just go and subscribe. We have a 2-week free trial. We don't require credit cards to be dinged or anything like that. I mentioned that last week. We don't do that. I don't ever put my credit card into a site that I'm not familiar with. And I don't expect anyone else to do that as well. So thank you again, and you have a good weekend. So long.